Hi, welcome to this video, which is all about Forex technical analysis techniques for profit, how to get a strategy in place with a trading edge which can lead you to success. And I also want to go through a fatal mistake that traders make in respect of technical analysis. Let's go to the fatal mistake first of all. And to illustrate this mistake, I just want to go to an interview that Jack Schwager did in the book New Market Wizards with a very famous options arbitrage trader, a guy called Joe Ritchie, a really successful trader. And he was speaking at a convention about trading, and in the audience there was a lot of famous names. So one of them was a guy called Richard Dennis. Many of you might know the name. He's the guy who developed the turtle trading rules and strategy, which was a technical system that really made a huge amount of money. And the two of them were having dinner afterwards. And Joe Ritchie says to Dennis, what fundamental information do you use in your strategy? And Dennis said, I don't use any fundamental information. You cannot argue with the fact that all fundamental information is reflected in the chart. And Ritchie actually said back to him, and you can't argue either with the fact that all technical information is reflected in the chart. And fair play to Richard Dennis, he goes, yeah, that's true, I hadn't actually thought of that. So what's so important about that then? Well, the obvious point you have to draw from that comment is that if you see the chart formation, so does everyone else. So if you see a major level, everyone else is going to see that major level. Now, that presents a problem for many Forex traders, because if you look at the way most people use Forex technical analysis, I always think they use it in a kind of textbook fashion, the way the textbooks tell you to use it. Now I've got probably, 100 books on technical analysis. None of them are going to give you a trading edge. It's all explained in the traditional way of how you should use indicators, trend lines, etc., etc. So when you come to trade Forex, you've got to think, okay, I want to trade with charts and major levels and so forth, but how do I compensate for the fact that the majority have all seen the same as me and want to trade off that level? And that is, I think, a question you have to answer when you devise your technical strategy. You do not want to be with the majority. It's just a great way to lose money. And I'm just going to give you some tips on getting away from the majority. I can't give all of the ones that I've got here, but I'm going to give you a few. First one, stops. Now, I spent 15 years as a broker, and I always noticed where these clients put their stops, because I was looking after margins a lot of the time. And what you always see is that the traders, especially beginners, retail traders, they always make the same mistakes with stops. They're always too close to the market action. Give you an example. Let's say you see a big price spike to the upside, it goes up. Next day starts to come off and come down. They'll all come in short, put their stops a few pips above the high. And then what happens most of the time is the market goes up, picks off the stops and immediately comes down. The trader will then think, the broker's taken my stop and taken my money. That isn't that at all. It's everyone is of the mindset of putting the stop in the same place. So I always think you've got to give a room to a stop. Placing your stop is actually, in my view, more important than getting in the market. I've really got no interest in getting in the market the best possible price and all this trade accuracy. I'm more interested in trying to make money from the trade and staying with it. And one of the best ways to do that is to make sure your stop is not too close. Another example is on breakouts. You often see traders, they'll go on a breakout just a few pips above the trend line and then stick their stop right behind the trend line. Well, that's a recipe for disaster longer term. Why? Because around big numbers or big levels, you are going to get what I call the spread of around 20 pips either side at least, where there's a lot of random noise which will catch those stops. So I think you want to give it a little bit of room. My own views on breakouts, give a little bit of room past the level just to confirm that the price is going to carry on. Most breakouts fail anyway, so that I always think that's a good thing to do. In terms of indicators, everyone tells you how they should be used, look at them, experiment with them, then use them the way that you want. Yeah, what works for you? I'll give you an example. I love the stochastic indicator. Everyone tells me, well, not everyone, a lot of people write to me and say you never always wait for that turn down through 80. I don't. Of course, I like turn downs through 80, but if it flat lines and it's like really, really overbought or oversold, just a little bit of a nudge down will do me. And I think you can do this with lots of indicators. Just skew them a bit or use them in a slightly different way to confirm your trades. So I think in terms of technical analysis and building a technical system, never fall for that fatal trap of devising a system which is similar to everyone else's. I very often ask people, what is your trading edge with that strategy of the majority? And you get that sort of blank look of I'm not really sure, I don't know. Well, if you don't know, then you shouldn't be trading. Basically, you need to know what your trading edge is over the majority. And I think we all have that same information to look at on the chart. And I think it's the way that you trade that information that is it's obviously so important, but so important that you do it in a way that's different to the majority. And I just want to make a comment on, talk about, technical analysis and fundamental analysis. There's always an argument which is better, and most traders say, the technical analysis is better. I don't think there's a clear-cut answer. I think, obviously, there's people who make a lot of money with fundamentals, a lot of people who make money with technicals. I honestly do think, though, that you can actually combine the two together. And you don't need to make a big study of the fundamentals to do this. You just need to know where the big fundamentals are going longer term. That will help you stick with long-term trends. Also, look out for clues in the fundamentals for what might happen in technicals. Like if you've got a very bullish news release, let's say everyone's expecting the news release to be bullish, and you can immediately position yourself to take a bearish view on the chart, on the sort of buy the rumor, sell the fact kind of a scenario. So I think, I've always said, Forex trading, very simple. Technical systems should be very, very simple. But we need to get away from the majority. The majority of traders lose. We've all got that same information to look at, see things differently, use things differently. Have a think, do some experimenting, and you'll soon get a simple strategy that's got a trading edge which can lead you to profit, which can be either technically based, or you can also use a little bit of the fundamentals as well to back up your trading decisions on the chart. So I hope you enjoyed this short video. Thanks for watching me as per usual. Take care. Have a good day.